Welcome to the chapter on candlestick patterns, which is an essential component of technical analysis in trading. Candlestick pattern offers a visual representation of the market sentiment and potential price movements, making them an invaluable tool for traders. In this chapter, we will dive deep into the anatomy of candlesticks, explore single and multiple candlestick patterns, and discuss how to apply this knowledge in real trading scenarios. A candlestick consists of a body and wicks. The body, which can be big or small, represents the open and close prices during a specified period. The wicks or shadows protrude from the top and bottom of the body, indicating the high and low prices of the period. The color of the body signifies whether the closing price was higher or lower than the opening price. Moving on to the single candlestick patterns, these can provide early signs of a potential market reversal or continuation. Let's explore some key patterns. Let's begin with the hammer candlestick pattern. The hammer is one of the most recognizable and significant candlestick pattern you will encounter in the world of trading. Let me simplify the hammer pattern, breaking it down so that by the end of this session, you will be able to spot and interpret it with ease. Imagine you are watching a market in decline. Prices are dropping and the overall sentiment is down. Then out of nowhere, you spot a candlestick with a small body at the top and a long wick trailing below it, much like a hammer. Now that's the hammer candlestick pattern for you. A symbol of hope in a downtrend, suggesting that the market could be about to turn around. Now let's understand the anatomy of the hammer. The hammer consists of three main features: a small body, a long lower wick, and a colorblind pattern. Let's understand one by one. So firstly, the small body. It's located at the top, representing a narrow range between the open and close prices. The high of the hammer will be very near to the close in case of a green candle, and it will be near to the open in case of a red candle. Then comes a lower longer wick. It should be at least twice the length of the body, indicating that prices significantly pushed down but then pulled back up. Finally, a color blind pattern. The color of the hammer body can be either green for a bullish signal or red for a less bullish signal. What's more crucial is the position and proportion, not the color. It must appear in a downtrend. So here's how you interpret the hammer pattern. When you spot a hammer at the bottom of a downtrend, it tells a story of trading session where sellers initially took control, driving the prices down. However, by the close, buyers managed to push the prices back up, closing very near to the open. This battle indicates that selling pressure is starting to decrease and a bullish reversal may be on the horizon. So here's how you can interpret the hammer pattern. Firstly, confirmation is the key. Always wait for the next candle to confirm the reversal. A bullish continuation of the pattern, that is, a green candle closing above the hammer's close, can serve as that confirmation. Secondly, volume matters. An increase in volume on the very next day of the hammer can strengthen the reversal signal. Finally, set your stop loss. Consider placing a stop loss just below the hammer's low. In this case, you can set a stop loss of 1520, which is below 1528, which is the lowest point of the hammer. This strategy limits potential losses if the reversal doesn't pan out. Notice here that a big red candle was formed 3 days after the hammer pattern. However, it did not close below the low of the hammer and our stop loss was never hit. As it can be seen, after the formation of hammer, the stock made a high of 1733, which is almost 14% up from the lowest point in a matter of 1 month without hitting the stop loss. Let's have a look at another case study. The most famous hammer candle in the Indian stock market was formed on October 27, 2008. Before the crash happened, the Nifty 50 hit an all-time high of 6357 on January 8, 2008. A few days later, the market began to crash. On the screen, you can see that Nifty 50 was trading at 5298 on May 2nd, 2008. What followed next was one of the most devastating bear markets in the history of Indian markets. For the next few months, the bear run continued. Most people sold their shares and left the stock market forever. The lowest point of the 2008 crash was on October 27, 2008. The date when the bullish hammer candle was formed on the daily chart, as it can be seen on the screen. The Nifty 50 opened at 2583, crashed to a low of 2252, rose to a high of 2585 and finally closed at 2524. On this day, the market witnessed panic selling. Now, if you were an investor on this day, you could have bought Bajaj Finance for just ₹7 and Kotak Bank for just ₹60. Almost all the stocks were being sold for throwaway prices. Majority of the market participation strongly believed that the market will crash further. But it is at this point of time the hammer candle got formed on the chart and the market began to recover. The trend reversal was confirmed on the very next day when Nifty opened at the same level as its closing on the previous day and rose further up during the day with good volumes. You can see that after the hammer, there was a confirmation candle that was formed on the very next day, that is 28th of October 2008, which closed above the hammer with good volumes. And it can be seen that gradually market recovered from the lowest point. Now note that the lowest point of the hammer, that is 2282, was never touched again in the entire history. There are many such examples of bullish hammer getting formed on the chart. It can be effectively used for short-term and long-term trades when a stock is in downtrend. It could mean buying 10 to 15% higher than the bottom, but the price will still be comparatively lower than the averaging done during downtrends. This strategy will require a lot of patience, but can prove to be very effective when candles like hammer are used in combination with other technical indicators. We will have a look at more such case studies as we move ahead in the program.